You've done the analysis. You spot a perfect breakout, execute the trade, and instantly the price surges 40 pips in your favor. The moment you see that green, your survival instinct kicks in. You want to lock in those gains and completely eliminate your risk, so you aggressively drag your stop-loss line right up to your entry price. This candlestick chart shows exactly what happens next. A minor retracement, a mere wick on the 15-minute time frame, drops down, barely clips your stop-loss, and then rockets another 150 pips in your original direction. You're left sitting on the sidelines. Most traders fail to capture these trends because they set their exit distance based on a desire for safety, rather than the actual range of the market. By aggressively trailing a stop based on a fixed pip count, you suffer from the choke factor. You are suffocating the trade by ignoring the natural market noise and temporary liquidity fluctuations that happen as orders are filled. Moving a stop loss to break even based purely on emotional fear effectively guarantees you will lose your position before the real institutional volume enters the market. Let's rewind that exact same trade back to the entry point and rebuild the exit strategy from scratch, removing the emotion. This diagram illustrates a standard professional metric, the one-to-one reward-to-risk rule. Before you are permitted to move your stop to break even, the price must travel a profit distance equal to your initial risk. You have to earn the right to protect your capital. This comparison shows why rigid pip counts fail. On the left, we have a quiet, low-volatility currency pair. On the right, a highly volatile one. A 20-pip trailing stop that works for the smooth pair will be triggered in seconds by the jagged fluctuations of the volatile one. We measure market breadth using the average true range, calculating average candle size. Multiplying this ATR by 2 creates a dynamic buffer. Notice how the trailing stop physically widens its distance from the price as the wave's amplitude increases. Basing your exit on the ATR replaces emotional guesswork with a measurement of current market noise, providing a statistical buffer for your trade to grow. Volatility is half the equation. Markets don't move in straight lines. They move in structural waves, creating a continuous series of peaks and valleys. This chart shows how to hide behind market geometry. A logical trailing stop moves up only when the market creates a new floor. Place your stop exactly below the most recent structural trough, using the market's buying power as a physical shield. If price breaks that shield, the core trend is broken. You want out. For vertical momentum trades, trail your stop dynamically below an exponential moving average ribbon, keeping a tiny buffer to survive false breaks. Sometimes, though, the market avoids your stop and your target entirely. It just goes sideways. This is dead money. Every hour your capital is tied up in a stagnant trade is an hour you are exposed to unpredictable news spikes without any upward momentum. Cut exposure with the 3-bar rule. If price hasn't made a high within 3 candles of your entry, aggressively tighten your stop or exit the trade completely. Mastering both structural space and time limits ensures you only expose capital when the price action is actively proving your thesis correct. Even with perfect structure, watching a massive open profit slowly drain back toward your break-even line is an incredibly heavy mental burden. This triggers equity curve anxiety. You see the peak of your profit, start viewing that money as yours, and impulsively close the active trade early just to secure a small win. Solve this using the pay yourself strategy. Cut your position block in half, locking 50% in the bank. With profit booked, widen the trailing stop on the remaining active position, giving it a stress-free buffer to survive retracements. The goal of trailing is to confidently capture the meat of the major trend. Review your last 10 shaken-out trades. Calculate how many of them would have survived and hit their targets if you had used an ATR buffer and structural logic instead of a tight fixed pip count. To put this into practice, download the FXNX ATR trailing stop calculator. It automates these dynamic math calculations for your next setup. Step out of retail emotional traps. Rely on the structure.